So number one, we had U.S. refining enter a maintenance turnaround. So we went from U.S. refining consuming 18% of the global market to 16%, so 18 million barrels a day to 16 million barrels a day. That's seasonal. It happens every time. Secondly, the entire market, I will say from a macro standpoint and from a producer standpoint, and I think from a political standpoint, was caught off guard by the Iranian waivers. Did not expect that. And in advance of Iranian waivers, Saudi and Russian production was ramped to offset the production coming off from Iran.
And if you're not, and by the way, this is an important story, Kate, and if you're not familiar with what Kate's talking about, so we put on these sanctions on Iran, and people thought 2.5 million barrels a day is going to come off the market.
November 4th.
But countries can go to the U.S. Treasury Department and request a waiver and basically say, I'll give you this, but let me keep buying Iranian oil. So far, 8 major countries have asked for and received waivers. In other words, that Iranian oil is still out there.
Well, the Iranian oil is out there while Russian and Saudi production ramped. And in addition to that...
Thinking the Iranian oil wouldn't be out there.
Exactly, to offset it as a global offset. And the other story that hasn't really been talked about too much is that the U.S. government released 20 to 30 million barrels of strategic petroleum reserves in the last 2 weeks of October and the first week of November to lower oil prices for consumers. And so as a result, you have a glut in the market, which is temporary, and it will work through, but it's going to take 5 or 6 months. And that strategic petroleum release will be tapered going forward. And also, eventually, Iranian sanctions, we think in kind of March, April, will come on. So the U.S. government has basically given Chinese, Korean, and Japanese buyers a chance to figure out where to source the oil apart from Iran. So we have a little glut. And
a little glut? If you go up to Canada, you can effectively get oil for free.
It's not,
because they can't get it out of there. So if you've got a truck, they'll almost give it to you for free, so you can just say, get it out, go away.
Well, the big thing is actually, if you look at U.S. inventories, they are very healthy, and global inventories have drawn this year. So I think the important thing is, if you look at the total volume of exchange-traded futures for crude, you will see that there actually is a situation where we have gone from, over the last 5 years, we've gone from, an all-time low of $28 a barrel to 77 in October. We've fallen from 77 to 44. During that time frame, if you look at the U.S. oil and gas companies, the XOP is at an all-time low.
It really is. And one thing we've tried to highlight, we're not trying to scare anybody with these names and stuff, but the oil industry is built on a lot of things: sweat, hard work, ingenuity, but also built on debt. Yes. And there's $240 billion in global energy-related debt that's coming to maturity in the next 5 years. Now, it's global, not all in the U.S. But we're seeing the debt story now kick back in again.
Yeah. I mean, energy has been a huge driver of the growth in the high-yield debt market. But these cash flow, if you are a CEO or a CFO of an oil and gas company, if you are a board of an oil and gas company right now, looking at forecasting $40 to $50 oil next year, you cannot increase rig count. In fact, you have to drop. And we saw Diamondback, the ticker is FANG, come out last night and cut rig count by 20%.
They're considered one of the more well-run of the oil and gas companies.
Yeah.
More fiscally conservative.
Yeah, and I mean,
they were not on our list of naughty.
No, that's a fantastic company. And I mean, you can buy them at 5.5 times cash flow next year. So next year we see multiple compression from EV to cash flow standpoint, and we also see ongoing leverage compression. The most important story for 2018 is that the oil and gas industry, which is known for outspending cash flow, got the message from activists and mutual funds teaming up and saying, do not spend cash flow on drilling, return it to shareholders. And fully a third.
But is that negative for economic growth? Because this has been a jobs driver in America the last number of years. It was the only industry adding jobs after the financial crisis, which is why we dug in so deeply onto it. If you're cutting CapEx, means you're cutting investment, which means maybe you're cutting growth.
Well, and I think the most important thing, earlier in the intro, you said this is good for, low oil prices are good for consumers. They are to a certain point, because the problem is, over a 36 or 48 month time frame, low oil prices mean companies don't reinvest in growing in growing production. A lack of growth in U.S. production means that we'll be in a situation where oil prices will skyrocket in 36 to 48 months. So having low oil prices creates the volatility where you ricochet between 30 and 70 or 30 and 80, and that's sort of what we're in. Stable oil prices are better for companies, and they're better for consumers.